Happy New Year and welcome to the Download Podcast. I am your host, Dave Richardson, and we are kicking off 2026 with a series of podcasts where we'll have top investment managers from all around the world taking a look at their regions, sectors in their region, or if we're talking to someone who covers a broader region, look at sectors, maybe even get into some specific names to set you up for success investing in 2026. And I can't think of anybody better to start the year off than our good friend, David Lambert, who covers Europe heads up Europe for RBC Global Asset Management. David, Happy New Year and welcome back to the podcast.
Happy New Year, and I agree. It's great to see your faces early on in the year and to be part of the podcast as usual, and happy to share my thoughts.
Yeah, and your last appearance was fantastic. We did a little bit of a review of 2026 or 2025 before looking forward to 2026, which we're going to spend the bulk of our time on today. But I think one of the things just to set up the entire year for those who are new to the podcast, and maybe you're just starting up. That's one of your New Year's resolution. Go to the best podcast I can go to learn about investing as a Canadian investor. And the Download is the perfect selection for that. Maybe even you were gifted a subscription to the Download underneath the tree or as just in a gift exchange, whatever it might have been. And just so you know, whoever gave you that gift really scrimped, because subscribing to the Download podcast is free. You probably don't know this, David. It was free last year. Even with all this talk about inflation, affordability, the Download podcast still free. You can subscribe wherever you get podcasts. So, and David, I know you're a little on the cheap side, so that was probably a gift you were giving away because the UK is very expensive. I was giving it to everybody. So you can just go sign up where you get your podcast. We are also on YouTube, so you can see David's fabulous smiling face. And on YouTube, we'd love you to sign up for that and like us. And all the things you do on YouTube, so you can follow us on every one of our podcasts. And again, the ones we're going to be doing through this month are all going to look forward into 2026. And so it's a great time to follow along because you'll set yourself up for the year. So with that, though, again, what I want to go to is a conversation we had before we even got on the podcast and started taping formally, because what I love about talking to investment managers is not just that they can give us guidance around how to think about investing. They are professionals, right? So think of we got the Winter Olympics coming up, David. Investment managers are like Olympic athletes, right? Now, if you're watching on YouTube, don't get all down on me right now, because clearly neither of us look like Olympic athletes, but David Lambert is an Olympic athlete in the brain, right? And that's because he spent his entire life preparing for becoming an investment manager and being a professional managing billions of dollars of investor assets. And that takes an incredible amount of discipline, focus, hard work to stay on top of the breadth of things that you need to understand and be aware of to be successful as a professional investor. Again, just like an Olympic athlete. So someone who's doing the biathlon. Biathlon's a good one. We had a lot of success in the biathlon in Canada before we were good at the Olympics. We had Maxime Bedard. Marianne Bedard was from Quebec. She was a biathlon champion. Biathlon, right? You've got to cross-country ski, so you got to be tremendously fit because it's in the cold, and then you have to calm your heart down to shoot at targets. And so the as we're going to get into, the Scandinavians particularly good at this sport, by the way. So we're going to get there in a second. And so you can imagine the amount of focus and training, right, that you need to do to get to that level in a sport that is so complex, that requires so much of your body, both in athletic endurance and calmness, the psychology of it. And so investment managers are like that. They're just so when you talk to an investment manager, which I get to do all the time and you get to listen to here on this podcast, It is incredible, their breadth of knowledge. So I make a little joke as we're teeing up and just saying hello to each other before we start the podcast about the about Danish war heroes, and that the Danes may need. And this is, we're not joking about it, because it's well, it may or may not be a serious thing. It's Trump talking about Greenland and that. But that we might need some Danish war heroes, or maybe there aren't any Danish war heroes, except David comes in right away and comes up with an amazing Danish war hero that connects to something I bet you don't know. Well, actually, connect to is exactly what it does. David, go ahead. Tell us the story of this incredible Viking war hero.
That's it. I learned it. I think when I went to Copenhagen one time, I was on a boat in Copenhagen, and they were talking about a 10th century Viking king called Harald Bluetooth, so King Bluetooth, who was a real person, and he was Norwegian, Danish, and effectively in the 10th century he unified all the tribes, won over everyone, and brought Christianity to Denmark. And as a consequence of Harald Bluetooth, when they came up with the connectivity between unifying devices, they gave it the name Bluetooth after the Viking king of the 10th century. So Bluetooth is actually named after a real person, and that's where it comes from.
And so you learn something every day, and you learn not just investing, but some other interesting things. But again, it just shows the breadth of and the as you say, you're just on a trip to Copenhagen, and you collect that information and you remember it. And so it's just the curiosity of investment managers is that other thing that is just fascinating about these people. And again, I have the privilege of spending so much time with them, and that's what we try to give you through this podcast, is that exposure to these very interesting minds with this incredible focus and their ability to work in David's case, in a particular area, which is Europe. And Europe, David, just very quickly, because again, you can go back and listen to the last episode with David. Great year in Europe last year.
Fantastic year. I mean, you know, in Canadian dollar terms, we were up sort of 30% virtually by the end of the year. You know, compare that to the US, in Canadian dollar terms was around sort of 15 to 20, 17-ish percent. So outperformed very strongly. That was actually on the back of very little earnings growth. You know, in aggregate in the region. So there was a lot of re-rating to a degree, but we got off to a very strong start at the beginning of last year as the German fiscal announcement came in early, and we saw Europe outperform very nicely the first 3 months, then sort of went sideways, worked off some of that sort of that re-rating. And then as we came into the year end, sort of started to accelerate again. So as you say, it was a very strong year. Was mainly due to re-ratings, but there were different things going on within Europe, which we've talked about, particularly with the domestic help, which we haven't seen for some period of time. And I think that's why the market got a sniff of this early on, then wanted to see, you know, how it was going to manifest. And I think this year is the year where we see this come into numbers. So particularly the sort of the German fiscal spend, infrastructure stimulus, we will start to see this come into order books, into numbers, into earnings numbers, companies talking about it. So it comes to life this year. Whereas last year was about hope and expectation and a re-rating. This year will be more about actually seeing earnings being delivered. And I think that's going to be the key for Europe this year.
Yeah, I think one of the most important things that that investors can take away from just what you shared is the whole idea of valuation when you're investing. And so when we did this same podcast a year ago, David, we and really we had been doing it for about a year prior to that. Every time you appeared, is the idea that the U.S. market, particularly in some areas, very expensive. And then you look at Europe and Canada and emerging markets, and in relative terms, their valuations were lower. So they were essentially, you were getting good value there. And at some point, right, and in this case, it was regardless of earnings moving, it was just like, hey, I'm paying this much for whatever earnings are in the US, and the earnings are good and they're growing well. I'm paying this much for earnings in Europe. And you know what? I kind of like this deal, because at some point these companies start to earn more, and so I'm going to get in advance. Then you roll in the currency, and of course the U.S. dollar weakness began really back in 2023, but has followed all the way through to now. And you have the combination the euro was relatively strong as well. You have a combination for Canadian investors that was very attractive, and certainly you took advantage of that in your portfolio last year because you had a tremendous year as well.
Yeah, I mean, that's absolutely right. And then as we look forward into this year, what we're expecting. So if we think about our starting valuations this year of being, mid to low teens in terms of PE. So let's talk about sort of 12, 13, 14 times as we look across the
Yeah.
regions relative to the US at 20 plus, 22 times earnings. But what we're getting this year, which we didn't see last year, was decent earnings growth. And if I look at consensus numbers, the ones I was looking at this morning, we were looking at sort of 15% earnings growth in the US, but also in Europe. So actually the earnings growth, now these are consensus numbers, and so there's always the propensity for these to sort of drift down, but the earnings growth is there. And ultimately on the starting valuations, we will start to see maybe a narrowing of the valuation differential of the European nations and the US. So that's what we're looking towards. So whereas historically, I would always argue the US should be more highly
Yeah.
valued because it's a higher return area of the market and does typically have higher earnings growth. But Europe this year is playing catch up, and it will be the fastest earnings growth we're seeing for nearly 2 decades outside of a recovery period. That's what we're expecting. So it could be what we're seeing on the face of it, a strong year. Now, obviously, there are always caveats to this and sort of, macro events that could come and derail things. But as it stands, it's looking like it could be the setup for a fairly strong earnings growth. And we could see re-rating on top of that, because I suspect as we look forward that the market might start to think about, is this an aberration in terms of a one-off sort of 15%, 10 to 15% earnings growth year? Or is the fact that Europe's actually seeing some fiscal stimulus, some infrastructure spend, means that
Yeah.
domestic earnings growth actually starts to improve, into the future as well. So it's a medium term effect as opposed to just sort of a 1 year effect. So that's maybe what we really need the market to get a hold of to then start to re-rate the European markets higher. But ultimately, the setup is decent earnings growth outlook on relatively low valuations. That's the basic message.
Yeah, and so as we always talk about the long nose of the stock market sniffing out that profit growth last year for this year, it's now looking into into the latter part of this year and into 2027. So what will be important is can that momentum continue? So we're likely going to see the markets telling us that the earnings are going to be good this year, and earnings growth is going to be good. But is this something that's going to be sustained as we move forward? Because there's been a fundamental change in the way Europe is thinking about managing economic policy in the face of what's going on in the US and in other parts of the world.
Yeah, that's right. I mean, clearly there's been some sort of navel gazing. They've been forced to sort of rethink regulation. They've been forced to rethink the way we administer debt, fiscal stimulus. These things that they're all self-help basically, and that has spurred. You're not going to see from an economic perspective, and you're best off talking to Eric Lassell about this, but from an economic perspective, you're not going to see great GDP growth. But ultimately, you just need to see incrementally better, and the kicker that has on earnings, on the domestic earnings sort of pool, will be quite significant. And let's not forget, on top of that, because Europe, as I always say, is the most globally diverse revenue region in the world, with revenues coming from all over the world, roughly a third Europe, a third emerging markets, a third North America. The North American and the emerging market earnings should hold up relatively well still anyway, but with this sort of third leg of the stool improving even more, should give you sort of a much higher base level earnings growth sort of going forwards. That's what we look for.
Yeah, and then as you say, you just get a little bit of an uptick towards the U.S. in terms of valuations, and maybe not into the mid 20s, but on a PE basis, but even getting up to 16, 17, 18, which is certainly reasonable given the interest rate environment. Then that bodes well for European stocks, and then bodes well for European stocks. I'll leave it there and let you make a comment.
The only other comment I'd make is the one thing we tend to forget as well is the dividend yield. we get a 3% dividend yield plus in European equities as well on aggregate. So there's actually that kicker as well. So let's go back to that sort of, say the 15% comes down to sort of 10 by sort of the middle of the year, but then we get the 3% dividend growth as well. It's that sort of, it's pretty significant off the low valuation base. So, we're very hopeful for the setup for European equities, and, as sort of as constructive as we have been for a period of time.
And David, the euro plays a role in this as well for Canadian investors. And so we've seen, I guess over the last 2 years, we've seen about a 15, maybe 18% move in the euro relative to the Canadian dollar. Is there still room for the euro to appreciate against the US dollar, and then in that case, it likely leads to better valuation against the Canadian dollar?
If we speak to our currency team, who are the
Yeah,
experts, they would
yeah,
suggest so. They would suggest that,
yeah.
there's still further to go on that front. So, and from a portfolio management perspective, that's great for our Canadian investors. We have to think about it in terms of, exposures on a company by company basis in terms of costs and revenues. So that's a sort of different dynamic. So actually, interestingly, as if you get a sharp increase in the euro versus the US dollar, as you did at the beginning of last year, then actually sometimes you see earnings downgrades because some of those US earnings gets downgraded because they're
Downgraded, yeah.
a little bit less. So you have to think about the puzzle. There's a lot of moving parts, but ultimately, yes, the stronger euro will be good for the asset class in a whole.
Which again just highlights the importance of or the value of having a professional involved in managing your investments, particularly when you get outside of Canada. Because as you
Yes.
said, I don't personally have a currency team that I talk to. You do when
Yeah.
you're managing your investments, right?
Yeah.
And that is an amazing resource because not only are you getting a forecast which helps you interpret where earnings are going to move across the companies that you're investing in, but it creates opportunities potentially for you to do things within the portfolio to either mitigate a pullback in the euro against the Canadian dollar, or to take advantage of a continued run in the value of the euro versus the Canadian dollar.
That's right. Like all the things we do, and we have so many inputs across asset
Yeah.
management in this firm, so many experts to talk to and get an opinion. You can create scenario analysis, and you can weight them differently according to people's different views. We have all of that, and we can incorporate all of that into the work we do. So we're incredibly lucky to have the resources that we do in the firm.
And that's what I said. Most individual investors, again, if I'm just investing in Canada, and it's not that currency doesn't play a role in the profitability of Canadian companies, in the way we think as an investor in Canada, because we're quite often going to take our Canadian dollars and maybe travel somewhere else in the world, and that has an impact on how we spend money in retirement or how we spend money even on a day-to-day basis. But when you start to invest outside of Canada as a Canadian, currency becomes something you need to think about, and the capability and the expertise that an investor like David has when he's investing in European equities compared to what I would have, just a normal investor, is absolutely incredible. A whole other team of Olympic athletes that we were talking about at the front end, who have lived their lives starting worrying about currency and understanding in detail how currencies move. And currency markets are more volatile than equity markets.
Yeah. And we don't try to forecast them at all. We speak to the
That's right.
experts and just try to understand the impacts that big moves in currencies can have on companies and portfolios.
That's right, exactly. So David, the theme last year in Europe, again, for lack of a better description, but this is a description that was used, was Europe was all about banks and tanks, and of course, there's been a reason for spending in the military. That's in the news. That's something that I'm sure most people listening to the podcast would be aware of. We talked extensively when we had you on last year about the rationale behind banks. And this is banks all over the world. But again, European banks were particularly beaten down coming out of the global financial crisis, which, believe it or not, is now 18 years in the rearview mirror. which is just incredible. So is it a continuation of that, or do we start to see some other areas of the European market start to take advantage of what's going on?
Well, there is. I think there's a continuation of that to a degree because of the really low valuation still. Even though this sector's been amazing, the financials and the banks
Yeah.
in particular, been absolutely phenomenal. But steepening yield curve, loan growth accelerating, the setup again on low valuations is really interesting. So for me, makes it a fairly low risk part of the market to be wanting to sort of be putting some of the dollars to play. But notwithstanding that, we have to understand that it is a cyclical part of the market. So we're always understanding the risks. Areas of the market that I think still look interesting and actually are less cyclical of healthcare, which is a sector that was beaten up hugely over the last number of years. And, from sort of the second half of last year, starting to improve in terms of performance. The sector got down to very low valuations, again, looking at valuations as an anchor, but with earnings growth coming through. And it's, not the earnings growth that we're talking about on aggregate that we're seeing in Europe of 15%, but there are plenty of decent healthcare names with double-digit earnings growth. So healthcare is an interesting part of the market and also plays that hedge if you sort of worry about the cyclicality. The market's run a bit hard, maybe it starts to rotate. But healthcare looks really interesting and is sort of counter to the banks in a way. We're still a bit cautious on the consumer. We've seen some signs of life in luxury, which is really interesting.
Yeah.
In China in particular. So the Chinese consumer, it had been in the doldrums, a good 2 years. We're starting to see signs of life. Companies like L'Oreal, LVMH have been talking about subtle improvements coming in China. So we're keeping an eye on that, but that could be interesting. But the consumer as a whole is an area where we're waiting to sort of see things start to turn and then start to sort of deploy more capital there. But at the moment, I think it's a little bit too early. Utilities, which again is a sector we've talked about a few times, but it's a sector we never would have talked about in the last 20, 25 years. But here we are talking about it again from a valuation perspective, but from a growth perspective as we think about global, electrification and the need for the infrastructure, transmission infrastructure. And, you think of the AI needs, the power consumption in this sort of huge AI spend we're seeing. So I think utilities sounds interesting still and looks interesting. And, and still, we don't play within Europe. The one thing to say, the differential between Europe and many of the other regions is technology. And we don't have the explicit AI plays that you would see in other parts of the world, which is a good diversifier. But there are plenty of sort of picks and shovels within the AI framework within Europe that we still think, given the vast spend we're seeing and the visibility you have on that spend, we still see these companies doing very well. And that's what you've got to think about. It's not, some of it's in the numbers, but that visibility goes on. So that's an area of the market we'd continue to sort of be looking at favorably, but with a mind on, one, the technical momentum and the earnings momentum in there. As soon as it starts to dissipate, we'd probably take the foot off the gas quite quickly. But two, we understand that valuations are fairly high in this sort of area of the market. So we're always mindful there. So that'd be the main things. And then just talking about going back to defense, which you talked about at the beginning, we still like defense, but that sort of re-rating that we saw, particularly over the last 18 months, that's gone. The companies are in a different place. They have got much longer order books. They have got much longer visibility, but they're on higher valuations. So I think we still see very good earnings growth within the sector, but it's on a higher valuation. So a lot of that is priced in. So I wouldn't want to be underweight defense. And ultimately, if you get peace dividends coming into the market and people getting worried about the defense names, the spend in defense, particularly within Europe, is going out for the medium to long term. These companies are in a good place. So if we see those come back, we would probably add to them, but I don't think it's a space you want to be massively overweight going into now. They've had a hell of a run.
Yeah, and so we talked earlier about the difference in valuation between the US and Europe. And then you have to look within the geography. And if you look at defense stocks within Europe, that's the example of a set of stocks you said that re-rated, so that their valuations are higher than other areas of the market. And so that creates, as you just suggested, well, if I'm looking at banks versus tanks, banks still have that long run and a great environment for their stocks to increase, but they're doing it from a lower level with dividends as well. right? Versus defense stocks, which are already very highly valued. So they need to continue to deliver at an even higher level to continue to move higher.
That's it. And we always frame it as a margin of safety. If you think about an asset that's priced, you got to think your margin of safety. What's baked into that price? What could go wrong, and which can tolerate. You can tolerate within the valuation, and what wouldn't. And when you get to those higher valuations, your margin of safety is that much lower. So that's what you got to think about on a stock by stock basis.
Yeah, I think of it because I often think at this point in the year of weight gain, right? So David represents Europe, and say I represent the U.S. stocks, right? And if we eat the same amount, but the multiplier to his weight is 14 times what he eats, and the multiple for me is 23 times what I eat, I'm going to get much heavier. And that creates a real problem because at some point you just get too heavy and you've got to cut back. You stop fitting in your clothes. And I'm thinking about that specifically, David, because I don't fit into most of my clothes right now. This is the time of year where we got to get serious. But again, it's that multiple, that lower multiple just gives you the ability, to eat a little bit more. That you say that little safety measure. So you don't have to take do that diet. You can still just do what you're normally doing and still continue to grow and move a little bit higher in terms of stock valuation. So it's an interesting phenomenon that we talked about on this podcast with several of the investment managers, be it someone from Canada, Europe, emerging markets, really anywhere but the US, and even within the US in a specific sector or area of the US. And then what we've seen over the last 18 months is what we've been talking about has come into play. So the key question for David today is that still in place for 2026? And I think what you've said is that you're quite optimistic about where you sit right now in Europe.
Yeah, absolutely. I think if you take it at the sort of face value, you don't have to see any re-rating. In fact, you could see a de-rating on 15% earnings growth and still get double-digit total shareholder return, given the 3% dividend yield as well. That's how you got to think about it. But I think ultimately, if the market gets comfortable with domestic Europe and in terms of the earnings growth you can see there's no reason why we can't continue to gently re-rate on top of the earnings growth. So yes, notwithstanding the sort of macro left field events, we'd be optimistic on the outlook for the year ahead.
Well, I tell you what, I'm optimistic and excited about in the year ahead, David. I get to come and visit you twice in the next 4 months. Always excited to see you face to face. And one of the things that we talk about Olympic athletes and health and all that. One of the things that David and I focus on when we get together is hydration. We're very big on hydration, right, David?
It's key for Olympic athletes.
Key for Olympic athletes. So I will see you on our favorite street corner in London to hydrate in early March. David, thanks for kicking off the year with the podcast for us. Again, I couldn't think of a better person to kick it off. And again, just really happy to hear that we've still got opportunity there. I think a lot of Canadians, because of your appearances on the podcast, took advantage of what was going on in Europe last year, and that's what we want to do here is give people that foresight to make the right little tweaks in their portfolio. And you've been fantastic. So, David, happy New Year! All the best to your family, and we'll see you soon.
Happy New Year! Thanks, Dave. Thanks for having me.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.